Governor Tiff Macklem of the Bank of Canada recently hinted at a potential shift in monetary policy for the upcoming year. Speaking in Toronto, Macklem suggested that the Canadian economy has moved beyond its overheated state, setting the stage for a possible shift in the bank's stance on interest rates. The final decisions of 2023 saw the Bank of Canada maintain its benchmark interest rate, a move that has turned heads in financial markets. Rather than anticipating further rate hikes, speculation has shifted towards potential rate cuts in 2024. Macklem himself has acknowledged this possibility, but also noted the bank's preparedness to raise rates if progress in taming inflation falters. As we move into the new year, it's clear that the Bank of Canada is anticipating a period of transition, with Macklem expressing hope for job growth later in the year. The Bank of Canada's rapid increase in the policy rate to 5.0% has placed substantial pressure on households, businesses, and governments. This surge has elevated borrowing costs significantly, a strategic move to address the inflation that had been running rampant. However, the effect of this decision has not been without consequence. Households feel the pinch as the cost of living rises, businesses grapple with higher operational costs, and governments face increased expenses in servicing their debts. In the corridors of economic thought, many economists have started to predict a decline in the policy rate for the coming year. However, they do so with a sense of caution, recognizing the potential challenges in steering inflation back to the central bank's target of 2%. Inflation, after all, is a complex beast, influenced by a multitude of factors, some of which are beyond the control of any central bank. While the central bank has made progress in cooling inflation, the path to the target rate remains uncertain. Not all experts are on board with the rate cut bandwagon. A symphony of differing opinions echo across financial markets. Among the skeptics is Derek Holt, who warns us against jumping on the rate cut bandwagon too soon. He argues that the month-to-month increases in core inflation metrics suggest more risk of another rate hike rather than a shift to cuts. The housing market, a cornerstone of the Canadian economy, is another area of concern. Some worry that a premature easing of monetary policy could introduce potential risks. But the same coin has another side. A number of experts predict an upswing in housing market prices following a Bank of Canada policy rate cut. They foresee a sluggish start to the housing market in 2024, but an eventual rise in prices and sales activity in the latter half of the year. While there is a mix of opinions, the general consensus is that the Bank of Canada's policies in 2024 will significantly shape the Canadian economy. Despite the challenges ahead, Macklem remains cautiously optimistic about the Canadian economy in 2024. He envisions it as a year of transition, a period of change and adaptation. Yet the path ahead is not without its hurdles. International events like the Middle East conflict and the upcoming US election could stir the global inflation waters, potentially impacting Canada's economic trajectory. Macklem acknowledges these complexities, understanding that they could complicate the bank's efforts to steer inflation back to its 2% target. Yet he also sees potential for growth, especially in the latter half of the year. He's hopeful that with the right policy decisions, the Canadian economy can weather these storms and remain resilient. But optimism doesn't mean complacency. As Macklem emphasizes, despite the optimism, the Bank of Canada emphasizes the need for vigilance. The future economic landscape is inherently difficult to predict, and so the bank remains alert, ready to navigate whatever twists and turns the economy may take in 2024.